Um, Usually when you sit down to study a business discipline, like accounting or corporate finance, there's this comforting expectation of absolute precision. I mean, it feels like engineering, right?
Yeah.
You look at a corporate balance sheet, the assets on one side and the liabilities and equity on the other, and they just match up perfectly. The accountant basically points to the bottom line and says, well, there it is, the book's balance.
Yeah, exactly. It gives you this tremendous sense of control over the numbers. It's binary. I mean, it balances or it doesn't.
Right. But then you step into the world of global macroeconomics, you start looking at the international monetary system, and suddenly that precision instrument just completely shatters. You're no longer looking at a clean ledger. You're looking at a financial landscape that is, frankly, incredibly murky. I mean, you have the competing interests of nearly 200 sovereign nations, all trying to balance their own domestic books while simultaneously reacting to the policy choices of literally everyone else.
Oh, it is the absolute definition of diagnostic muddy waters.
Yeah.
You have trillions of dollars crossing borders, governments printing money, central banks hoarding foreign currency, and trade imbalances just constantly shifting the geopolitical tectonic plates.
Yeah, and if that massive interconnected system fails, international trade quite literally stops. I mean,
Yeah.
cargo ships don't leave port. Global supply chains freeze up. Multinational corporations can't price their goods or manage their risks. So today, we are going to look under the hood of the operating system of the global economy. If you're an ambitious student preparing to conquer the complexities of the international monetary system, maybe getting ready to sit for a major MBA exam on this exact topic. Well, our mission today is to thoroughly unpack the evolution, the institutions, and the deep mechanics of global monetary and exchange rate arrangement.
And we're going to explore this sort of 150-year quest to find the perfect financial anchor. That way you understand the underlying logic of every concept, historical shift, and mathematical formula that you'll be tested on.
Exactly. And we've got a comprehensive stack of academic material in front of us covering all of this.
We do. And, the key to mastering this material isn't just rote memorization. It's about understanding the why. Once you grasp why governments were forced to abandon physical gold or why the International Monetary Fund calculates a country's power using a very specific mathematical formula, all those granular details just naturally lock into place in your memory.
Let's start with the architecture of global finance itself. What exactly is the International Monetary System, or the IMS?
Well, the material defines it as the completest set of rules, practices, instruments, facilities, and organizations that regulate international trade, investment flows, and cross-border payments. Ultimately, I mean, the IMS is the framework that justifies and dictates how the financial gains from global trade are distributed among different countries. Yeah, and it's really important to conceptualize the IMS not as a single building or like a single legal document,
Right.
but as this massive overlapping web of agreements and behaviors. And this entire web rests upon two foundational pillars. The first pillar is exchange rate management, and the second pillar is reserve management.
Okay, let's break those down, starting with exchange rate management. This is essentially the choice a country makes about how to value its national currency against the rest of the world, right? And the material outlines a full spectrum of options. On one extreme, you have fixed exchange rates, where a country legally mandates that its currency is worth a specific amount of another currency, or a commodity like gold.
Right, and then moving along that spectrum, you have these intermediate options. You have an adjustable peg where the rate is fixed but, can be changed under extreme circumstances. You have a crawling peg where a central bank allows the currency to gradually appreciate or depreciate in a sort of controlled manner to avoid sudden economic shocks.
And then you get into the floating options. A managed floating system, which is sometimes called a dirty float, is where the currency's value is mostly determined by the free market, but the central bank will intervene and buy or sell its own money if the price swings too wildly.
Exactly. And finally, on the far opposite end of the spectrum, from a fixed rate, you have a freely floating currency, where the government steps back entirely and just lets market supply and demand dictate the value every single second of the day.
Which brings us to the second pillar, reserve management. This pillar is about what a country actually holds in its central bank vaults to back up the choices it made in the first pillar. Like, if you're going to manage your exchange rate, you need ammunition. Historically, that ammunition was physical gold. Later, it became single foreign currencies like the British pound or the US dollar. And today, it's most commonly a diversified basket of different global currencies and liquid assets.
Yeah, so the combination of these two pillars, how a country values its money and what it holds to defend that value that dictates the state of the IMS at any point in history. But, how do we objectively evaluate if the system is actually robust? If you're looking at a multiple choice question on your exam about the effectiveness of the IMS, the material highlights 3 specific parameters you need to know.
Okay, lay them out for us.
The first parameter is the ease and speed with which a country can correct a balance of payment, or BOP, disequilibrium. And the crucial caveat here is doing so with minimum cost to its residents.
Let's clarify what a BOP disequilibrium means in real terms for the students listening. If a country is running a massive trade deficit, meaning it's importing way more goods than it exports, it's bleeding wealth. So the first parameter basically asks, can the global monetary system help this country fix that imbalance quickly without the country having to plunge its own citizens into a brutal recession or hyperinflation to correct the math?
Precisely. I mean, if correcting a global trade imbalance requires a country to suffer 20% unemployment domestically, the system is not robust, it's just punishing. The second parameter is the availability of reserves. When a balance of payments crisis inevitably hits, does the system have enough liquid reserves available to deploy immediately to stabilize the situation?
It's like asking if the global fire department has enough water in its tanks when a whole city block catches fire.
That's a great way to put it. And the third parameter is purely psychological, which actually makes it fascinating. It's confidence.
Yeah.
Do governments, multinational businesses, traders, and individual investors actually have faith that the system's rules are efficient and fair? You can have all the reserves in the world and perfect exchange rate mechanisms, but if confidence evaporates, capital flight happens instantly. Investors panic, they pull their money out, and the whole system collapses regardless of the underlying math.
Man, that's so true. And all 3 of these parameters serve 2 massive macroeconomic goals that every single country is constantly juggling. That's internal balance and external balance. Let's define these clearly for the exam. Internal balance is basically the domestic dream. It's achieving full employment while maintaining price stability. You want everyone to have a job, but you don't want the cost of a loaf of bread doubling every week. You want to keep inflation in check.
Right. And external balance, on the other hand, is about the country's relationship with the rest of the world. It's about avoiding extreme, unsustainable imbalances in your balance of payments. You don't want crippling permanent deficits, but you also don't want massive unending surpluses that disrupt the economies of your trading partners either.
So if I'm an MBA student trying to picture this, think of managing a national economy like driving a car. Achieving internal balance is about keeping your own engine running perfectly. You want the RPMs high enough to cruise at a good speed that's full employment, but you don't want to push the engine so hard that it overheats and catches fire, that's inflation. Achieving external balance is making sure you aren't bleeding fuel out of your gas tank onto the highway that would be running a massive, unsustainable trade deficit.
I love that analogy. And the profound challenge of the international monetary system is that every country is driving their own car, trying to manage their own engine and their own fuel tank. But they're all driving on the exact same highway at 80 miles an hour.
Yeah, and because they're physically integrated on the shared road through international trade, one driver's attempt to fix their internal balance can cause absolute chaos for everyone else's external balance. Like, if a massive economic semi-truck suddenly slams on the brakes to cool down its overheating engine, maybe by jacking up interest rates to fight domestic inflation, it can cause a 50-car pileup behind it. Capital gets sucked out of smaller economies, currencies crash.
And this inherent tension is exactly why nations are forced to cooperate. They have no choice but to establish traffic laws, speed limits, and a highway patrol. A purely isolationist economic policy is just impossible in a world of interconnected trade. Over the last century and a half, the world has basically experimented with 3 very different traffic systems to manage this highway. The first was the gold standard, which ran roughly from 1870 to 1914. The second was the Bretton Woods system from 1946 until 1973. And the third is the post-1970s system, largely coordinated by the International Monetary Fund.
But before we explore those 3 distinct historical eras, we need to understand the fuel inside these economic engines. We need to look at what countries are actually holding in their vaults to back up their financial credibility. And that brings us directly to the concept of reserve currencies.
Right. So a reserve currency is defined as a currency held in significant quantities by governments and central banks as part of their foreign exchange reserves. They hold these currencies to settle international transactions, to support the value of their own domestic currency, and, to pay off foreign debt obligations.
And if a country holds a massive stockpile of highly stable reserve currencies, it directly improves their sovereign credit rating, right? It proves to the world that they have the liquid assets to cover their debts. But how does a specific currency earn the right to become a global reserve? Like, I can't just print my own currency, call it a global reserve, and expect the Bank of England to start hoarding it.
Definitely not. The barrier to entry for a reserve currency is incredibly high. The issuing country must meet three strict criteria. First, the country must represent a massive percentage share in world output and global trade. You basically have to be an economic titan. Second, the country must wield significant geopolitical power. The currency needs the implicit backing of a stable, dominant government.
And the third criteria is perhaps the most critical from a functional standpoint, which is that the country must possess a deep, highly liquid financial market.
Exactly. When we say deep and liquid, we mean that a foreign central bank can buy or sell billions of dollars worth of assets denominated in that currency in a matter of seconds, without those massive trades causing the market price to wildly fluctuate. If a market is shallow, trying to sell $1 billion of assets will crash the price before the trade even finishes. Liquidity essentially provides safety.
So let's trace the historical shifts of these heavy hitters. For much of the 19th century and the first half of the 20th century, the British pound sterling was the undisputed king. It was the primary reserve currency, reflecting the immense global reach of the British Empire and the dominance of London's financial markets.
But the economic devastation of two world wars and the subsequent weakening of the UK economy in the second half of the 20th century severely undermined the pound. It could no longer meet those three criteria on a global scale. And this paved the way for the United States dollar to achieve dominance.
Right. Following World War II, under the Bretton Woods system, the U.S. dollar became the foundation of global trade. The source material notes that throughout recent history, an average of 2/3 of total allocated foreign exchange reserves globally have been held in U.S. dollars. It offers unmatched stability and is backed by the deepest, most liquid asset market in the world, which is U.S. Treasury securities.
However, it's worth noting that the dominance of the dollar isn't absolute, and it is actively being challenged. The material points out growing concerns regarding the dollar's long-term stability, largely tying to U.S. domestic spending and debt levels. Central banks are increasingly looking to diversify to protect themselves.
Which brings us to the euro. The euro is the second most commonly held reserve currency, making up roughly 25% of allocated holdings. Its share has steadily risen as central banks seek alternatives to the dollar, and as the economic integration and trade within the Eurozone continues to expand.
Then we have the Japanese yen. While holding a smaller overall percentage, the yen is a critical global reserve. It is a foundational component of the IMF's valuation basket. Its official value is determined daily based on exchange rates quoted at exactly noon in the London market. Furthermore, the yen is utilized specifically by the Japan External Trade Organization for official procurement, cementing its operational importance.
But the most fascinating recent development, and something you absolutely need to highlight if you're taking notes for the exam, is the rise of the Chinese yuan, also known as the renminbi. The material emphasizes that the yuan gained official global reserve status relatively recently, specifically in November 2015. It effectively became the fifth major reserve currency and now accounts for close to 11% of the IMF's total reserve currency basket.
This is a monumental shift. If you encounter a test question asking which currency is currently threatening the dominant position of the U.S. dollar, the Chinese yuan is the definitive answer based on the curriculum. This rise is directly driven by China's explosive expansion in world economic output and its massive share of global trade, which obviously fulfills that first core criterion of a reserve currency.
So if I'm managing a central bank today, the strategy has clearly evolved. I mean, I'm no longer just hoarding one single currency. Putting all my nation's wealth into just US dollars or just euros seems like an unnecessary risk. Isn't that why the text mentions a shift toward holding a basket of currencies depending on trading partners?
It absolutely is, and that is a critical exam point. It's portfolio theory applied at the macroeconomic level. The shift from the solitary dominance of the pound to the solitary dominance of the dollar, and now to a multipolar landscape that includes the euro, the yen, and the yuan, reflects a deliberate global risk mitigation strategy. If the U.S. economy suffers a severe downturn, foreign central banks don't want their own national reserves to be wiped out in the collateral damage.
Makes total sense. But if we rewind the clock, historically, countries didn't use paper money from other nations to mitigate risk. I mean, they didn't trust paper at all. They trusted heavy physical metal. To truly understand the foundational mechanics of fixed exchange rates, we have to examine System Version 1.0, the era when gold was the ultimate unquestioned reserve asset.
Yes, the gold standard. The classical period of the gold standard ran from roughly 1870 to 1914, though it was officially adopted as a standardized monetary system much earlier, in 1819. During this era, gold wasn't just sitting in vaults backing up paper. Physical gold coins were actively circulating in the public economy as a medium of exchange, a unit of account, and a store of value.
The mechanics of how this system managed international trade are brilliant in their simplicity. And because the source material provides a very specific mathematical breakdown of how this worked, it is highly probable you will be tested on the calculation. Let's knock through the math step by step.
Okay, so the core rule of the gold standard was absolute parity. Every participating government pegged its national currency to a fixed, unchangeable weight in gold. The central bank of that nation had one primary overriding responsibility, which was to stand ready to buy or sell gold in exchange for its paper currency at that exact fixed price no matter what.
Right. And the text uses the US dollar and the UK pound as a historical example. It states that the US government defined $1 as being equal to exactly 23.22 grains of physical gold. This translated to an official convertibility rate of $20.67 per ounce of gold.
Meanwhile, the British government defined the UK pound as containing exactly 113.0016 grains of gold.
So because both currencies are permanently locked to physical gold, calculating the exchange rate between the dollar and the pound requires no market speculation at all. It is pure arithmetic. You simply divide the gold content of the pound by the gold content of the dollar. So you take 113.0016 grains and divide it by
23.2 grains, yeah.
Exactly. And the result of that calculation is 4.87, meaning the official exchange rate was permanently fixed. It took exactly 4.87 US dollars to purchase 1 UK pound.
Think about what this means for a business. If you're a shipping merchant in New York buying textiles from London in 1890, you know with absolute certainty what the exchange rate will be tomorrow, next month, and next year. That 4.87 ratio is locked in physical metal. This mathematical elegance created immense confidence and fueled a massive expansion of global trade.
It seems like a beautifully simple math equation, so why did it fail? I mean, was it just a lack of discipline?
The simplicity of the gold standard was ultimately its fatal flaw. The system was just entirely rigid. It stripped governments of the ability to use monetary policy to manage their domestic economies, and the primary catalyst for the collapse was the catastrophic expense of war.
Right. When World War I erupted, governments faced a sudden existential crisis. They needed to manufacture millions of artillery shells, build fleets of ships, pay millions of soldiers, and they needed to do it immediately.
But under the rules of the gold standard, a government could only print as much paper money as it had physical gold in its vaults. The war efforts cost exponentially more than the gold reserves held by European nations. Governments basically had to choose between adhering to the mathematical purity of the gold standard and losing the war, or abandoning the gold standard to print the money they needed to survive.
Naturally, they chose survival. They suspended the convertibility of paper to gold. They printed massive amounts of unbacked currency. They even experimented with bimetallic standards, trying to use both silver and gold to artificially inflate their monetary base. But of course, once you break the peg, the confidence in the system evaporates.
Yeah, and after the war, there were attempts to resurrect the gold standard, but the global economy had fundamentally changed. Governments were now deeply involved in managing their domestic economies. They realized that being chained to a fixed amount of physical metal meant they couldn't lower interest rates or increase the money supply to fight unemployment during economic downturns, like the Great Depression. The inflexibility of gold violently clashed with the modern necessity of fiscal and monetary policy.
By 1933, the major governments effectively centralized control. They reserved monopoly privileges over the supply of their national currencies for their central banks. The text explicitly states that this transition proved the gold standard was an ineffective and inconsistent restraint on national fiscal policy. You just cannot run a modern, dynamic economy tied to a rock dug out of the ground.
So the world entered the 1930s and 1940s in a state of monetary chaos. Countries arbitrarily devalue their currencies to make their exports cheaper, trying to steal trade from their neighbors in a desperate bid to create domestic jobs. This beggar-thy-neighbor economic warfare deepened the Great Depression, and ultimately contributed to the tensions that sparked World War II.
Yeah, and as World War II dragged on, global leaders recognized a dual reality. First, a return to the rigid straitjacket of the gold standard was economically impossible. But second, the chaotic, weaponized currency markets of the 1930s were equally disastrous. If they were going to rebuild the world after the war, they needed a completely new, negotiated, and highly structured financial architecture.
And that profound realization gave birth to System Version 2.0, the Bretton Woods system.
This is one of the most consequential moments in financial history. In July 1944, while Allied troops are literally fighting their way across Europe, 730 delegates from 44 different nations gather at a massive hotel in the mountains of Bretton Woods, New Hampshire. Their objective is staggering: design the financial operating system for the post-war world.
It's incredible to think about. These delegates were acutely aware of the failures that preceded them. The new system they designed was built on three foundational principles to ensure those failures were not repeated. First, the primary goal was to facilitate unrestricted international trade and cross-border investment. Protectionism had to end.
Second, to provide the stability that businesses need to trade, they agreed to establish fixed exchange rates. National currencies would once again be defined in terms of gold parities, but they introduced a crucial, flexible twist that the original gold standard lacked.
Yes, and this is key. While the rates were fixed, a country was legally permitted to adjust its exchange rate, but only in the event of a fundamental disequilibrium in its balance of payments.
Okay, pay attention here, because that phrase, fundamental disequilibrium, is a massive trigger word for your exam. Under Bretton Woods, a country couldn't devalue its currency just because it wanted a slight export advantage. But if a nation suffered a catastrophic structural shift, say, their primary export industry was permanently wiped out, and they could never mathematically balance their books at the current exchange rate they were allowed to reset their peg. It was an escape valve that the old gold standard never had.
Exactly. Now, the third principle was the creation of a global safety net. The delegates agreed that international liquidity had to be made available to countries suffering from temporary short-term balance of payment deficits. If a country had a bad harvest and temporarily couldn't pay its import bills, it shouldn't be forced into a devastating recession. It should be able to borrow emergency reserves to ride out the storm.
And there was a fascinating debate at Bretton Woods about how to manage the safety net. The material details a proposal for a clearing union, which was essentially a global central bank. Under this concept, every country would get a line of credit to prevent severe deficits. But the clearing union idea was radical because it also sought to punish countries running massive surpluses.
Right. The logic was that a surplus in one country mathematically requires a deficit in another. So if a nation exported too much and accumulated excessive wealth, the clearing union would force them to remit that excess back into the global system, or it would authorize discriminatory trade practices against them to balance the scales. The proposed resources for this global fund started at $5 million and grew to $8.5 million.
Ultimately, the more aggressive elements of the clearing union were rejected, but the core concept evolved into the establishment of two monumental institutions that still govern global finance today: the World Bank Group, which was tasked with providing long-term financial assistance for post-war reconstruction and development, and the International Monetary Fund, or the IMF.
The IMF officially came into existence in December 1945. Its primary mandate was to act as the referee of the new system, monitoring exchange rates and lending reserve currencies to nations facing those temporary balance of payment deficits. By 1958, the Bretton Woods system was fully operational globally, with major currencies becoming freely convertible for current account transactions.
So what were the actual mechanics of this new system? Well, it was called the par value system, and it functioned very differently from the old gold standard where everyone pegged directly to gold. Under Bretton Woods, only one currency was anchored to gold, and that was the U.S. dollar. The United States government guaranteed that it would exchange dollars for gold at a permanently fixed rate of $35 per ounce.
Every other participating member country then pegged their national currency not to gold, but directly to the U.S. dollar.
So Bretton Woods was basically a hub-and-spoke model. Picture a bicycle wheel. Every other nation's currency, the British pound, the French franc, the Japanese yen, they were the spokes, all attached to this central hub, which was the U.S. dollar. And the dollar was the hub because it was securely anchored to physical gold in Fort Knox at $35 an ounce.
That is an elegant way to visualize it. And it provided incredible stability. For the first 15 years, it fueled a massive global economic expansion. But the entire architecture relied on one critical assumption, which is that the hub, the United States, would maintain disciplined domestic policies to ensure the dollar remained as good as gold.
But what happens when the hub starts spending recklessly? I mean, when it behaves badly, the system begins to tear itself apart. The material meticulously outlines the demise of Bretton Woods. By the early 1960s, the fatal flaw in the architecture became apparent. The fixed value of the US dollar against gold was becoming heavily overvalued in reality.
And this was due to massive structural shifts in the U.S. economy. The text specifically highlights a sizable increase in U.S. domestic spending. This was the era of the Great Society programs, coupled with a dramatic rise in military spending due to the escalating Vietnam War and broader Cold War commitments.
So to fund all this massive spending, the U.S. was effectively printing more dollars than it had gold to back them up at the $35 an ounce rate. They were running huge, continuous balance of payment deficits, just flooding the world with U.S. dollars.
Yeah, and the rest of the world, particularly European central banks, they looked at the mountain of paper dollars they were accumulating. They looked at the finite amount of physical gold sitting in American vaults, and they realized the math was rapidly deteriorating. The implied promise that they could all trade their dollars in for gold at $35 an ounce became a mathematical impossibility.
The anchor was lifting. The text notes that this realization triggered a massive flight of liquid capital away from the United States. Investors and foreign governments began dumping dollars and demanding physical gold. The U.S. gold reserves started plummeting at an alarming rate.
The pressure cooker finally exploded in August 1971. In a move that truly shocked global markets, President Richard Nixon unilaterally announced the temporary suspension of the dollar's convertibility into gold.
The famous Nixon shock. He severed the anchor. The U.S. government essentially told the rest of the world, look, the hub-and-spoke system is over. We will no longer exchange your paper dollars for our physical gold.
While the dollar had been straining under pressure throughout the entire decade of the 1960s, this specific abrupt policy shift in 1971 marked the definitive, irreversible breakdown of the Bretton Woods par value system.
The major economic powers tried frantically to negotiate new, adjusted, fixed exchange rates in late 1971, but the underlying imbalances were just too severe. The new pegs couldn't hold. By March 1973, they finally surrendered. The major global currencies simply abandoned fixed rates entirely and began to float against one another, their values determined minute by the open market.
And the source material explicitly points out that since the final collapse of the Bretton Woods rules, IMF members have been granted complete freedom to choose any exchange arrangement they wish. But with one solitary exception, they are legally prohibited from pegging their currency to gold.
Wow, really?
Yeah, they can allow their currency to float freely, they can peg it to another strong currency, they can peg it to a diversified basket, they can adopt another country's currency outright, like Ecuador adopting the US dollar, or they can form a brand new monetary union, which is exactly what Europe did with the Eurozone.
But this transition to a floating world created an existential crisis for the International Monetary Fund. Think about it. The IMF was created specifically to monitor and manage a world of fixed, pegged exchange rates. With the pegs gone, did the world still need the IMF? The answer was a resounding yes, but the institution had to fundamentally reinvent itself to prevent chaos in this newly unshackled system.
And that brings us to the modern era of the IMF as the global system administrator.
Let's trace this evolution. The IMF originally opened its doors for business in March 1947 with an initial membership of just 30 countries. Today, it has expanded massively to include more than 185 member nations. The material notes it encompasses nearly every economy on the planet, with only a few isolated exceptions like Cuba, North Korea, and Taiwan.
Right, and following the shattering of the Bretton Woods system in 1971, the IMF's Board of Governors recognized they were in completely uncharted territory. In 1972, they established a specialized committee of 20 members to investigate how to overhaul the international monetary system.
This committee identified three fundamental systemic weaknesses that had destroyed the old system. First, an inadequate supply of international liquidity. Second, a terminal lack of confidence in the reserve assets. And third, a complete failure of the adjustment mechanisms when trade imbalances grew too large. This deep diagnostic review ultimately led to a sweeping set of amendments to the IMF's Articles of Agreement, which were officially implemented in 1976, codifying the modern floating rate era.
Now, if you are studying the structure of the modern IMF for your exam, there's a conceptual trap you must avoid here. The text lists the IMF's statutory purposes and then separately lists its functions. Test makers love to blur these together in multiple choice questions to see if you actually understand the distinction.
Yeah, that's a classic trick. If I'm looking at a multiple choice question asking for the primary difference between the IMF's purposes and its functions, how do I separate them in my head?
The clearest way to divide them is philosophical versus operational. Think of the purposes as the grand overarching goals of the institution, the why it exists. Think of the functions as the daily operational actions the staff takes them, how it achieves those grand goals.
Okay, let's define the why first. The material outlines 5 statutory purposes. First, to promote international monetary cooperation through a permanent institution that provides the machinery for consultation and collaboration. Second, to facilitate the expansion and balanced growth of international trade, which in turn contributes to higher levels of employment and real income for member nations.
Third, to promote exchange stability and maintain orderly exchange arrangements. Crucially, this includes avoiding competitive currency depreciations. The IMF exists to stop countries from weaponizing their currencies to steal export market share, basically avoiding a repeat of the 1930s.
Fourth, to assist in establishing a multilateral system of payments for current transactions and to eliminate foreign exchange restrictions that artificially hamper the flow of world trade. And fifth, to alleviate serious disequilibrium in the international balance of payments of members by making the fund's resources available under adequate safeguards. This ensures countries don't resort to destructive measures that endanger global prosperity when they run out of cash.
So those are the grand philosophical goals. Now, let's look at the how, the 5 specific functions of the IMF. First, it regulates economic and financial developments globally and provides explicit policy advice to its members.
Second, it acts as a financial backstop. It physically lends money to member countries that are actively experiencing balance of payments difficulties.
Third, it doesn't act as a passive ATM. When it lends money, it actively supports and often mandates specific macroeconomic adjustment and reform policies within those borrowing countries to fix the underlying rot that caused the crisis.
Right. Fourth, it operates as a global consulting firm. It provides extensive technical assistance and training to member governments, helping them build competent central banks, design tax systems, and manage public debt.
And fifth, it is one of the world's premier economic research institutions. It conducts deep research, compiles massive statistical databases, issues global economic forecasts, and performs rigorous analysis tracking the health of the global economy.
The material specifically groups that first and fifth function the regulation, advice, and data collection under a critical term, surveillance. Because national economies are deeply intertwined, a reckless fiscal policy in one country can cause massive spillover damage across borders.
Yes, through this surveillance function, the IMF acts as an early warning system. They send teams of elite economists into member countries to audit their books, assess their economic health, and identify vulnerabilities before they trigger a crisis. They collect mountains of data and publish it in standardized, globally accessible reports, most notably the International Financial Statistics. This transparency forces governments to be honest about their financial health.
And the IMF doesn't operate in a vacuum. The text highlights that it collaborates extensively with a network of other global institutions. It works closely with the World Bank, various regional development banks, the World Trade Organization, and UN agencies, with each bringing their own distinct expertise to complex economic problems. It also engages continuously with the G20 leadership, international think tanks, and the financial media.
But to execute all of these functions, to conduct global surveillance, deploy teams of economists, and lend billions of dollars to countries in crisis, the IMF requires a massive pool of capital. It also requires a highly precise mathematical mechanism to determine the economic weight and influence of its 185-plus member nations. I mean, who pays into the fund, who gets to borrow from it, and who gets to make the rules.
Exactly. To do all this lending and surveillance, the IMF needs serious funding. To understand that, we have to look directly into the engine room. Let's examine the internal organization, the critical concept of quotas, and the mechanics of SDRs.
Organizationally, the IMF is headquartered in Washington, D.C. The day-to-day operations are led by a managing director, who serves a dual role as the head of the operational staff and as the chairman of the powerful executive board. This managing director is supported by a first deputy managing director and 3 other deputy managing directors. This executive management team directs the staff and maintains high-level diplomatic contacts with governments worldwide.
But the true locus of power within the IMF isn't determined by the management team, it is determined by the quota system. This is an absolutely vital concept for your exam.
Yeah.
When a country joins the International Monetary Fund, it doesn't just sign a charter and get an equal seat at the table, it is assigned a highly specific mathematical quota.
Right, and the material notes that a new member's initial quota is assigned in the same general range as the quotas of existing members who possess broadly comparable economic size and characteristics.
But how do they objectively calculate that economic size? They don't just guess. The IMF uses a rigid quota formula. If you are preparing for a test, you must understand the logic behind the specific weights in this formula. The current formula calculates a country's quota based on a weighted average of 4 distinct macroeconomic variables.
The largest and most important variable is the country's gross domestic product, or GDP, which carries a massive 50% weight in the formula. But this GDP measurement is itself a highly deliberate blend. It is calculated based 60% on market exchange rates and 40% on purchasing power parity, or PPP, exchange rates.
Let's unpack why they blend those GDP metrics, because that's the kind of deep insight that separates an A student from a B student. Market exchange rates measure how much raw financial power a country has on the international stage. But PPP exchange rates measure what a country's citizens can actually afford to buy locally. By blending them 60-40, the IMF creates a metric that respects the brute financial force of rich nations while also giving fair representation to developing nations that have huge domestic economies but weaker currencies. It's a carefully engineered compromise. So GDP is the anchor at 50%. What are the other 3 variables?
The second variable is openness, which carries a 30% weight. This measures how deeply integrated a country is into global trade. A country that exports and imports massively relative to its size will score higher here.
That makes perfect sense. The IMF exists to manage international trade, so countries that trade more should have a bigger say in the rules.
The third variable is economic variability, weighted at 15%. This metric tracks a country's historical vulnerability to sudden shocks in its balance of payments. If a nation's export revenues wildly fluctuate year to year, perhaps because they rely on a single volatile commodity like copper or oil, they score higher on variability.
And the final variable?
The fourth variable is the country's international reserves, weighted at just 5%. This measures the stockpile of foreign currency and gold they hold. The text also mentions that the final calculation includes a mathematical compression factor. This is a statistical tool used simply to reduce the extreme dispersion in calculated quota shares, ensuring the largest countries don't completely eclipse the smaller ones mathematically.
So if you're trying to lock this formula down for your exam, 50% GDP, 30% openness, 15% variability, 5% reserves. Understand why those metrics matter: size, trade integration, volatility, and financial ammunition, and you won't need to arbitrarily memorize the numbers. Now, here is where the mechanics get slightly abstract. These quotas are not denominated in US dollars or euros or yen. They are denominated in an entirely unique asset created by the IMF, special drawing rights, or SDRs.
The definition of an SDR is a classic exam trap. You must be very precise here. The material explicitly defines the SDR as the IMF's internal unit of account. Crucially, the SDR is neither a currency, nor is it a direct financial claim on the IMF itself.
Wait, let me stop you right there, because this counterintuitive concept trips up so many students. You're saying an SDR isn't actual money. Like, I can't take a million SDRs and use them to buy oil on the open market. And even more surprisingly, I can't take my SDRs to the IMF headquarters in Washington and demand that the IMF hand over physical cash from their own vaults in exchange.
That is entirely correct. You cannot use it to buy goods directly, and the IMF will not cash it out for you from its own reserves.
So what exactly is the point of an SDR? The text calls it a potential claim. So it's basically a VIP ticket that gives me the right to ask another country for their usable currency.
That is the exact right way to think about it for an exam. It is a mechanism to access liquidity. Nations holding SDRs can obtain these usable currencies in 2 distinct ways. The first is through voluntary exchange. Country A might quietly approach Country B and say, look, we need US dollars to pay a debt. We will transfer our SDRs to your account if you transfer dollars to ours. These voluntary trades happen continuously behind the scenes.
But what if no one volunteers? What if there's a massive global panic and no country wants to give up their precious US dollars?
That is where the power of the IMF comes into play. The second method is by IMF designation. The IMF has the authority to formally designate members who have exceptionally strong external financial positions, meaning they are running healthy surpluses and have deep reserves to purchase SDRs from members with weak, precarious positions.
So the IMF can look at a wealthy, stable country and legally mandate you are required to take these VIP tickets from this struggling nation, and you must give them hard currency in return. It forces liquidity to flow to where it is desperately needed, preventing a localized crisis from triggering a global cascade.
Exactly. Now, how do they determine the actual value of an SDR if it isn't a currency itself? The value is derived from a weighted basket of major global currencies. Historically, this valuation basket consisted of four dominant currencies: the US dollar, the euro, the Japanese yen, and the British pound sterling.
But as we discussed when talking about reserve currencies, the geopolitical landscape shifted. The text highlights a highly significant change. The IMF expanded the basket to officially include the Chinese renminbi, or yuan, as the fifth currency, effective from October 1st, 2016. This was a formal recognition by the IMF of China's immense weight in global trade.
To give you a sense of scale regarding these quotas, the material provides specific figures you should be familiar with. The largest single member of the IMF is the United States. As of the data from January 2016, the U.S. quota was roughly SDR 42.1 billion, which translated to about 58 billion US dollars. Conversely, the smallest member is the tiny island nation of Tuvalu, with a quota of just SDR 1.8 million, or roughly $2.5 million.
The overall size of the fund's resources is massive. Following the pivotal 14th General Quota Review meeting in January 2016, the member nations agreed to a historic increase. The total combined quotas of all 189 members were essentially doubled, rising from approximately SDR 238.5 billion to a staggering combined total of SDR 477 billion.
Understanding the history of why the SDR was created provides vital context. It was originally invented in 1969, during the latter days of the Bretton Woods system. At that time, global trade was expanding so rapidly that the existing international supply of physical gold and US dollars was proving totally inadequate to support the volume of transactions. The global economy was facing a liquidity shortage. The SDR was engineered as a supplementary reserve asset to artificially inject liquidity into the system.
But ironically, just a few years after the SDR was created, the Bretton Woods system collapsed. Currencies began to float, global capital markets exploded in size, and governments found they could easily borrow the reserves they needed directly from private international markets. So the desperate systemic need for the SDR lessened significantly.
It lessened, but the IMF didn't dismantle the mechanism, and history proved that to be a remarkably wise decision. Fast forward to the catastrophic 2009 global financial crisis. Private credit markets completely froze. Banks stopped lending to each other, let alone to struggling nations. The global economy was facing a devastating liquidity drought.
The system was completely parched.
In response, the international community utilized the SDR mechanism to orchestrate a massive coordinated rescue. They authorized a general allocation of SDR 182.6 billion. This single action instantly injected desperately needed liquidity into the global economic system, supplementing member countries' official reserves and providing a lifeline when private capital had entirely evaporated.
So the VIP tickets, which had been somewhat sidelined during the boom years, suddenly became the most critical mechanism for survival when actual cash stopped flowing. Now, recognizing how these quotas dictate financial contribution leads us directly to the most controversial and highly tested aspect of the modern IMF, who actually holds the power. Section 8.7 of your material covers the power dynamics and lending operations of the IMF today.
At its core, the IMF is owned and directed by the governments of its member countries. These nations exercise their authority through a board of governors. Typically, the individual representing a country on this board is a high-ranking economic official, usually their Minister of Finance or the governor of their central bank.
But the voting structure of this board is not a democratic one-country, one-vote system like the UN General Assembly. It's supposed to be a global cooperative, but it essentially operates like a corporation where you buy voting shares. The text explicitly notes that voting power is strictly allocated in accordance with the size of a country's shareholding in the fund, which is entirely determined by their quota size.
And this quota-based voting structure creates a stark, undeniable power dynamic. The material points out that many of the most important structural decisions regarding the IMF's operations require a supermajority vote of 85% to pass.
And what is the exact voting share of the United States?
Based on its massive quota, the United States currently controls 17.78% of the total voting power.
The math there is brutal and inescapable. If the U.S. holds 17.78% and you need 85% to pass a major rule, the math dictates the U.S. is the only country that can unilaterally block anything. It means the U.S. possesses an absolute veto over any major structural decision at the IMF.
It absolutely does. And this highlights what the text describes as the contradictory views surrounding the IMF's modern role. On paper, it is presented as a universal, cooperative global institution working for the macroeconomic stability of all nations. Yet its strict corporate voting structure leaves the ultimate, overriding control heavily skewed toward a single economic superpower.
Despite this tension over power and governance, the IMF remains the indispensable global lender. Let's look at the mechanics of how it actually deploys its capital. When the IMF provides credit to a member country, the official terminology is that the country is making drawings on the fund. And this credit isn't handed over in one massive lump sum. Since the 1950s, the IMF has structured its credit in what are called tranches.
Right, a tranche is simply a slice or a unit of credit. Specifically, these tranches correspond to blocks representing 25% of a member country's total quota. By releasing funds in these sequential tranches, the IMF maintains leverage. They release a tranche, evaluate if the country is implementing the required economic reforms, and only release the next tranche if the country is complying with the agreement.
While the standard lending operations function this way, the IMF also serves a critical developmental role. It acts as a provider of heavily subsidized credit specifically designed for low-income member nations. A country qualifies for this special assistance based on its per capita income levels and its eligibility for concessional lending from the World Bank Group's International Development Association, known as the IDA.
The flagship IMF program for this subsidized lending is called the Enhanced Structural Adjustment Facility. The exam material provides the exact loan terms for this facility, and you should be familiar with the structure. When a low-income nation qualifies, the loans are not dispersed immediately. They're made available in 3 distinct installments doled out over a 3-year period.
And the financial terms are incredibly generous compared to the open market. These loans carry a minuscule interest rate of just 0.5%. Furthermore, the repayment schedule is highly extended, ranging from 5.5 to 10 years after the funds are officially dispersed, giving these fragile economies a massive runway to stabilize and grow before the debt comes due.
It is a vital lifeline. But even this highly subsidized credit comes firmly attached to the IMF's surveillance and structural adjustment conditions. The money is cheap, but the policy advice is mandatory.
Well, we have journeyed through an immense amount of macroeconomic history and complex architecture today. Let's do a rapid-fire recap of the key takeaways for your exam prep, just to ensure you have a cohesive mental framework before you walk in.
Good idea. The overarching narrative is the world's desperate attempt to balance domestic economic needs with global stability. The international monetary system is the evolving set of rules, the traffic laws designed to manage exchange rates and reserves so that global trade can function without causing devastating pileups.
Right. We saw how the original traffic system, the gold standard, relied on absolute mathematical rigidity. It provided immense confidence because exchange rates were locked to the physical weight of metal, but it ultimately collapsed because governments couldn't use monetary policy to fight wars or cure domestic depressions.
Then came the Bretton Woods system in 1944, a brilliant compromise, a hub-and-spoke model that allowed currencies to be fixed to the dollar while permitting adjustments only in cases of fundamental disequilibrium. It birthed the IMF to manage short-term liquidity crises. But it ultimately failed in 1971 when the hub, the United States, printed too many dollars to fund domestic and military spending, breaking the dollar's link to gold.
Which pushed the world into the modern era of floating exchange rates. Without fixed pegs to monitor, the IMF reinvented itself. Its purpose remains global stability, but its daily functions shifted to deep surveillance, technical assistance, and acting as the global lender of last resort.
And we explored the mathematical engine of that power, the quota formula based primarily on GDP and openness, that 5030155 split. This quota determines both the country's voting power, granting the U.S. its unique veto, and its access to the IMF's unique accounting asset, the special drawing right, the ultimate VIP ticket for global liquidity.
If you understand the underlying tensions that drove these historical shifts in mathematical formulas, the specific details will come so naturally to you on the test.
Before we conclude, I want to leave you with a conceptual question to ponder, something that takes the mechanics we've discussed and project them into the future of global finance.
Ooh, okay. Where is the system heading?
We've seen the evolution of reserve currencies, we watched the pound falter, and we're currently watching the absolute dominance of the dollar slowly erode as countries diversify into the euro and the newly added Chinese yuan. The historical pattern is clear. Relying on any single national currency as the global anchor inevitably leads to instability, because national governments will always eventually prioritize their own internal domestic balance over the external balance of the global system. The anchor always wants to lift.
Because domestic politics always trump global responsibility in a crisis.
Precisely.
Mm-hmm.
So consider the trajectory of the special drawing, right? Right now, it is just an accounting unit, a mechanism for central banks to swap currencies in an emergency. But what if, decades from now, the SDR transcends its current limitations? What if, in response to a future crisis of confidence in the US dollar or the yuan, the international community agrees to elevate the SDR into the sole, universally traded global reserve asset?
Wow. So removing national currencies from the reserve vaults entirely.
Exactly. Could a globally managed, mathematically weighted basket of economic value finally achieve the perfect, frictionless external balance that the rigidity of the gold standard and the flawed hub-and-spoke model of Bretton Woods both failed to deliver?
That brings us full circle. We started by contrasting the messy reality of macroeconomics with the clean precision of accounting. Perhaps the ultimate solution to the muddy waters of global finance isn't a national currency at all, but a pure, mathematically balanced equation managed by a global consensus. It's a profound thought to carry with you as you continue your studies. Thank you for joining us on this deep dive into the architecture of the international monetary system. We wish you the absolute best of luck on your exam.